In the last lesson, we met Eric, who started a car making business. We were introduced to the concepts of profit and opportunity cost. In economics, we like to emphasize the opportunity lost when we discuss the cost of an activity. While he likes making cars, Eric is not so good with numbers. So he has asked his friend Al, the accountant, for advice on whether his business is profitable. Eric and Al sit down and run the numbers. Eric sells his cars for 100 pieces and sells one per day, pieces being the name of the currency where Eric lives. He pays 50 pieces per car for supplies and 10 pieces per car for renting a yard. These opportunity costs are obvious. He could have spent that money on something else. Al does the calculation. 100 minus 50 minus 10. The accountant declares Eric's profit equal to 40 pieces per day. Eric lets out a sigh of relief. 40 pieces per day seems pretty good. But wait! An economist arrives on the scene. That's not really profit. Numbers don't lie. Take that back. How can I take it back when I know you have not included all the costs? Like what? Like the value of the tools and Eric's own time. But he didn't pay for any of those. But they still involved a lost opportunity, and thus should be included for calculating profit. Now then, let's calculate profits the economist way. This ought to be good. If we add in the opportunity cost of the tools and Eric's time, as the economist suggests, then we have 100 minus 50 minus 10 minus 20 pieces he could have gotten if he had rented the tools out, minus 30 for the money he could have earned working for somebody else. That would suggest Eric is losing money and should stop making cars. But suppose that the price increased to 111 pieces. In that case, the economist would say the profit equals 111 minus 50 minus 10 minus 20 minus 30 equals 1 piece profit. A lot of people would say a profit of 1 piece, that's not worth it. You can't make a living on that. You'd starve. But remember, an economist includes under costs the value of Eric's time. In effect, the opportunity cost of paying a salary to himself. Also included is the opportunity value of the tools. In effect, the opportunity cost of renting the tools to himself. So Eric is not starving by making cars. If we assume he gets the same amount of enjoyment out of making cars as he does out of the next best alternative, then he should definitely make cars when the price is 111, because he'll be 1 piece richer making cars. At his next best alternative to making cars, he makes 30 pieces per day working and 20 pieces per day renting out tools for a total of 50 pieces per day. But when making cars, he makes 1 piece per day plus the 30 pieces per day for his time and 20 pieces per day renting out his tools, totaling 51, which is better than 50. See? I said he should be making cars all along. Only if the price is over 110 pieces, not when it's 100 pieces. Let's see if the economist is right. When the price is 100, then Eric's next best alternative would still earn him 50 pieces per day. That doesn't change. But when making cars, he would lose 10 pieces per day. If we add back in 50 pieces per day for his time and tools, he is left with 40 pieces per day. In this case, he would be better off with the alternative, making 50 pieces per day. Economics triumphs again! Or maybe not. For our calculations, we assume that Eric got the same amount of pleasure out of working at his next best alternative as he does out of making cars. If that's not true, if he really likes making cars more than the alternative, maybe it is still worth making cars, despite the loss in profit. Maybe he gets more out of making cars than just the price he receives. There's also a bunch of unstated assumptions, like we assume he can easily find someone to rent his tools. Hopefully, though, you get the point. In this lesson, we learned the difference between what an accountant means by profits and what an economist means. They are different because economists include indirect opportunity costs that accountants typically do not. Next lesson, we'll look at what happens when Eric needs to increase production.